for that, Mohit. Awesome. Hello, everyone. Good afternoon, good morning, good evening to people who are joining from different locations. It's always good to see a good turnout for a session which is quite awaited, and we have been looking forward to it, gathering a lot of personalities to talk about, and also two people and participants who are looking forward to this. Now, just to introduce me before we start off, this is Rohan Mathews. I head the global business for QuantInsti overall. So I would like to welcome all of y'all, both panelists and or the participants who have joined in. And of course, there are some EPATians who are already connected with us as alumni. So welcome to you all too. Before we go ahead, let me just do a quick check if all can hear, view, and see the screen. So if you all can just put a yes on the Q&A panel, so you can see a Q&A box in your Zoom panel. So if you can just let us know if everything is good to go. Thanks, Raghu. Thanks, Andres. Thanks, Arn. Thanks, Israel. Thanks, Saveen. Awesome, great. So everything looks good to go ahead. Okay, so the title of this session is Build Your Quant Portfolio and the first steps into algorithmic trading. You can see the panelists below, but of course I will do the due introductions a little ahead in time in the session. Before we dive in, I would like to quickly know from where you guys are joining in, because we do have a large number of registrants, and it'll be great to know from which city/country that you all are joining in. London. Oh, I can see first two Londons. Lovely. Edinburgh, Scotland, New Jersey, Ahmedabad, Argentina, London again, Canada, Brazil, Singapore again, Mumbai, Gurgaon, Hong Kong, Argentina. Lovely. I think that's a good mix of crowd, and I think it's a good mix of panelists to do the due justice required. Awesome. Good to see hundreds of participants who have joined in across thousands rather, and around 90 odd countries that people are registered with, right? Now, I have been trying that the session should be quite interactive. So keep utilizing, if not exploiting, the Q&A box in your panel. Keep adding your questions, and we will try to answer as many as we can, ones for the panelists and one for QI in general. We'll try to cover that, right? And having said that, let me just give you a brief idea about the agenda, right? So first, we will start off with a deep dive into building quant trading portfolio. Now, of course, we have got Jay here who would be helping us with that. I will eventually introduce Jay during the session. Then we have got two gentlemen, Tomás and Mrinall, who would be helping us with their stories, their real life scenarios, and how they transitioned into quantitative roles as professionals. And then yours truly, I would take you through the EPAT program, a little tidbits about how the program is structured, what is going to be the journey if and when you happen to join. And every session will have its Q&A part to address, right? So after every session, we'll have 10 to 15 minutes that we will delve into your questions. So like I said, feel free to add your questions as we go. Right, so gentlemen, if you all, especially Mrinall and Tomás, if you all want to stop your cameras, and then we can, of course, request you to join back when we introduce you in this session. Thank you for joining, and until then, I will take the liberty to introduce our first speaker, that is Jay Parmar. He's a quantitative researcher at iRage. He's our own EPAT faculty with the EPAT or overall faculty cohort. And he's also a co-author of a very well-received Python basics book, which is an illustration from financial markets. To start the day, we would be focusing on the foundation of algorithmic trading, how to think like a quant, design portfolios that are both data-driven and execution-ready. Jay Parmar, as I mentioned, is a seasoned quant researcher from with a leading algo trading firm, which is also an HFT, that is iRage. And because of our proximity with through EPAT, I very well know Jay and how he has paved his way through his journey in quant and algorithmic trading. And in this session, Jay will cover how to generate different strategy ideas based on real data patterns, how to perform rigorous backtests, which we heavily believe in, incorporating machine learning into trading workflows, and making models ready for real world execution. Because that's the prime question most of our participants ask about, okay, you can create models, you can create concepts. How real world ready are these? Right? So that is where Jay would come in the entire game. So Jay, I would like to give this platform to you and you can take it over, please.
Thank you so much, Rohan, for the introduction, and it's a pleasure to be here. So let me share my screen first. Just nudge me and confirm if I once my screen is visible to you guys.
It's visible to me, Jay.
Okay, great. Thank you so very much for the confirmation, and I welcome you all to this webinar, wherein we are going to spend time discussing the steps that one should think about while building a quantitative portfolio, and during the process we'll discuss like what thing goes into such a thought process, right? So to begin with, the very first thing that we have is the objective, right? Now, whenever we build a portfolio, what should be the objective of that portfolio? And usually this objective keeps on changing depending on the entity or the uh, modeler or the person who is building this portfolio. So for most of the retail traders, when it comes to building a portfolio, usually their thought process is to build a portfolio uh, on a longer horizon, on a longer term basis, uh, to support their future goals. For someone like a professional trader, when it comes to building a portfolio, their thought process is to build a portfolio of strategies uh, that meets their risk profile. Okay. On the other hand, when it comes to building a portfolio of for entities like hedge fund, uh, they think of building a portfolio containing multiple asset classes uh, to achieve capital appreciation or generate alpha, right? So depending on what course of life that you come from, the objective of the portfolio building changes, or I'd say varies depending on what you want to achieve. So the very first step that one needs to really ponder on is to decide on the objective of the portfolio, like whether you want to build a portfolio that supports your long-term goals, or you want to build a portfolio of strategies to meet your risk appetite, or you want to achieve capital appreciation. Regardless of the objective that you select, the rest of the steps will change, right? Let's say or consider that we fall into the very broader category of quant traders, wherein we want to build a portfolio of multiple strategies such that it also achieves capital appreciation, and it also meets our risk appetite, right? So on those lines, the next step that comes into the picture is the strategy selection. Like again, what kind of strategies that one should select to build a portfolio of the strategy. Okay, so over here I have listed a few commonly used strategies across the industries, starting with a long only momentum strategies and all the way up to arbitrage strategies. However, when it comes to building strategies, or I'd say building trading systems, I think more of these strategies as the phenomenons. Okay, so for me, these are not strategies, but rather a phenomenon that occurs repetitively in the market, and how we can capture these phenomenons to capitalize on that part, or on these phenomenons. Okay, so for example, the very first over here is the long only momentum. So which simply says that whenever a trend builds, or whenever the prices tend to move in a certain direction, which we call as a trend, and if we can somehow quantify that trend building activity, right, we could capitalize on it. So by observing the markets, we know that the prices usually either tends to rise or fall or stay in some range. We want to capitalize when the prices rise. Okay, and we would say that, okay, if somehow we can quantify that aspect, that when the prices are rising, we can enter when the trend starts, and then we can capitalize on that part. One of the ways to quantify momentum or a trend is to calculate the absolute returns, and if that absolute returns are positive in a given period, we say that there exists some kind of momentum. We keep on scanning this kind of momentum on a regular basis, or I would say repeatedly over past few minutes or past few days, and whenever the absolute returns crosses some threshold, we say a particular instrument is showing some momentum, and we jump to enter into that instrument and ride that momentum. Another way is another way to capture a momentum is to use some kind of technical indicators, right? Wherein we say that, for example, moving average, wherein we say that if the prices are above some moving average, we say there is a momentum, right? So essentially, what we are trying over here is like we are capturing some kind of phenomenon. Uh, on the long short side, again, what we do is we try to build some kind of market neutral portfolio such that we tend to capitalize on the direction of the direction of the instruments that they are currently into. For example, I would say that I will build a portfolio wherein I will go long whenever the RSI goes below 20, and I will go short whenever the RSI is above 80. Now, to build a long short portfolio, what I will do is I will go ahead, I will scan the whatever instruments that I have in my universe. I will pick up uh, uni, uh, all those instruments where the RSI is above 80 and where the RSI is below 20. Based on that filtration, I will go long and short in an equal proportion. Now now this equal proportion could be in terms of capital, it could be in terms of risk, it could be anything. Okay, but what I'm doing over here is like I am going long and short at the same time over periodically to keep my risk minimal. Okay, or I would say at least I try to keep it neutral. So that is the another phenomenon, which is the long short. The third one is the mean reverting strategies, which is like we observe in the market that there are certain variables which tend to stay in a range. Okay, and if those variables deviate from that range, we initiate positions accordingly. One of the examples that many of you guys would have heard is about pairs trading, wherein we take two instruments, at least two instruments, we calculate their spread, and then we study the spread between those instruments. Now, most of the time, those spread might not be co-integrated, so we need to keep that in check. However, if we assume that the spread is co-integrated and the spread stays in a range, and if if there are times when the spread deviates from that range and it breaches some threshold, we initiate the positions accordingly. Why we do that? Because based on the historical data, based on the historical pattern, we know that this spread should stay in the range. As the spread has deviated from the range, it has breached those levels, it will come back to the mean of the spread, and it will eventually come within the range, right? So when it comes back to the range, we close the positions. So that was the third phenomenon. The fourth one is the volatility strategies, right? Which is highly popular among the options traders, wherein people try to capitalize on the volatility. So it is a common observation among the options trader that realized volatility is usually lower than the implied volatility, right? So if somehow we can quantify that difference and we can initiate positions that can help us that can help us earn some bucks from the difference between the IV and the RV, right? We could basically run a portfolio of those instruments. So that is the fourth phenomenon. And the fifth one is the classical arbitrage strategies, wherein uh, we try to buy the cheaper and sell the expensive, right? So if a particular instrument is being traded on multiple avenues and we find that an instrument is available for a cheaper price on on one avenue, and it is available for sale or vice versa on another avenue, we do the arbitrage. Okay, now this example is of the same instrument across the exchanges or across the avenue, which is also known as the cash to cash arbitrage. There could also exist another kinds of arbitrage, which is probably say future cash to future, right? So there exists this mathematical relationship between the futures and the cash, right? In terms of cost of carry, and if that cost of carry is being violated, one could enter into the arbitrage trade and capitalize on that part. Not only futures or the cash, arbitrage strategies could also be applied in the options market, right? So for example, say someone trading put call parity. So by design of the options instruments, they should always it should always respect the put call parity. If that put call parity violates, one could enter into such instruments, one could enter into such uh, trades where they can enter into offsetting positions and capture that violation. Okay, so these different strategies essentially are nothing but the different phenomenon that exist in the market uh, time and over again. And if one could quantify these phenomenon, they can go ahead and they can capitalize on that part, right? So this is usually the second part or the second step while building a portfolio, that is to select the kind of phenomenon that we want to uh, capitalize on. So if I want to if I am a retail trader and if I only want to go ahead with, let's say, long only things, right? I could go with momentum strategies. If I am a professional trader with having accessibility to different trading instruments, I could do pretty much arbitrage or volatility or long short or anything, right? So the second step is to select the strategy. Now, say we selected the strategy based on the objective that we have defined over here. Okay, based on this objective, we selected a certain phenomenon that we would want to capitalize on. So the next question is, like, where do I find uh, the some implementations or some research on on any of these phenomenon, right? So what are the avenues or the sources where I can go ahead, read on those phenomenons, make myself capable enough to understand how a particular phenomenon works, and how I can implement it according to the objective of my portfolio. So over here, I have listed various sources of these phenomenons or the strategies, so, as we say them. So the first one is the research papers, right? And these are some of the quite well-known research papers across the phenomena that we just discussed, right? Uh, which are extensively used across the industry as well as academics, right? To study uh, them to study these phenomena in different geographies, different horizons, and whatnot. So what we see over here are a few uh, popular momentum research papers as well as systematic trading papers and whatnot, right? So any one of you who would want to get started with, you guys can take a look at these papers, go through them, see how it fits in your trading journey. And yeah, you can like just try to get yourself elevated by reading these papers, seeing how you can replicate them. And once you replicate them, see like again what else you can do, right? Where more you can contribute to this field, right? So this is the the very first thing that usually professionals do, that they go through research papers, they try to make themselves comfortable with those ideas, they try to study that phenomenon across horizons, across geographies, and then they try to build an opinion that whether they should go ahead or not, right? Now say you did that part, you went through multiple research papers, you became more interested, and you now want to study more on that part, right? You want to explore that field more, right? So what are the different sources from where you can get those research papers? And some of these sources which I extensively use are ssrn archive, right? And the Wiley online library. So these are the pretty good resources in terms of finding what you want to work on, right? Once you go through these things, go through these resources, you will find like again there are many like-minded people who have contributed on various terms, on various topics, on what you wanted to do, right? And you could learn from how those phenomena are implemented, from where like under what scenarios it work, like what are the tricks and tips of the phenomena that should be kept in mind while replicating them, right? So these are some of the sources that you can use to get to dive deeper into the selected phenomenon that you have, right? That you have selected. The next one is the books by the industry professionals, and here are some of the my personal favorite books with regards to coming up with a trading strategy, or how we can go ahead and learn more about those uh, ideas, right? And to come up with the whole to prepare the overall structure to create the or to come up with the trading system. Now, over here in the first section, you would see the books for momentum trading. The middle section contains book for the systematic trading and the algorithmic trading. And the last one specifically talks about the volatility trading, which is which largely covers the three different phenomenon that we discussed in the previous slide. Okay, so any one of you who wants to go ahead and who wants to implement, these are the resources to start with, right? The third resource is usually the articles written by peers or the like-minded people on various forums like medium.com, or nowadays I see increasing participation on uh, LinkedIn Pulse as well, or website like blog.quantinsti.com, where the person where the people who wants to build a career or who are industry professionals come and write their ideas and come and share their experiences about what they did, what they tried, and how it went, right? So these are the articles that usually gives us exposure into the real working of these phenomenons. And last is the discussion with peers. So if you have that accessibility, if you know people in the industry, if you know certain people like who works these kind of things, they could enlighten you with the real workings of it, right? They could give you the tricks of the industry, like what works, how it works, what should be taken care of, and what not, right? So these are the sources that one could try with, one could start with. Okay, now again, understanding about this phenomenon is one thing, but how do you validate it? Okay, how do you validate it? In a sense that, okay, you say you came up with your objective, you decided like what kind of phenomenon that you want to use, you dive deeper by going through multiple papers, multiple sources, you read books, and now you are pretty much convinced about that phenomenon, right? And now you want to capitalize on it, but before you do that, you want to go ahead and like you want to validate your idea, right? The exact logic that you have in your mind, you want to validate on that part, right? So what are the options? So before you do that, like before you go and like you invest your money or you start building portfolio, you need to you wanted to get that assurance that, okay, you know what, like I have this idea, I know that similar idea works, but like will this specific instance of idea would work, right? So in order to do that, we simulate that idea, okay, which is also known as the backtesting, right? So backtesting is a process where we take historical data, we apply the exact logic of the phenomenon that we have came up with on that data, and we see like how that particular how that eventually turns out to be. Now, majority of the times, usually retail people would want to build their custom tool that okay, they would obtain their own data, they would apply the logic, and they would want to simulate it, right? Some would do in again the beginner one would do in Excel. uh, a professional one would do in a Python programming language, or a similar programming language, but they would build their custom tool, that custom backtester, and to get different metrics to see how the portfolio did uh, in the history, in the past, from multiple perspective. Okay, or one could use the research tools like Blue Shift, okay, which comes up with pre-built data, and the ready to use analytics, wherein like traders need to that just put in their logic and run the simulations, and it would basically give you like, okay, like depending on your exact logic, uh, how it would have performed in the past. Okay, And then the third option is the proprietary tools, which we usually see in the organizational settings, that most of the organizations they would have their own proprietary framework built uh, to lower the turnaround time, to lower the validation time for the kind of strategies and the kind of data that they use and they work with. Okay, so like these are like broadly different ways. Okay, now when it comes to a person like me, what we do is like when we backtest a strategy, we usually try to validate that strategy from multiple perspectives or multiple angles as such, which is to begin with we would say that okay, if I'm building a portfolio, uh, like again, how much risk I am taking uh, compared to the returns that my portfolio is generating, which usually goes by the name of a Sharpe ratio, right? Another thing that we would like to see is the maximum drawdown, right? And this is where the this research tools like Blue Shift or any other really helps us is like we put in the idea, we put in the logic, and the tools will create like compute all these metrics, right, while simulating the portfolio. Now there could be like endless list of what metrics that one should look for, but again, uh, the metrics that one should really go ahead with would usually change depending on the entity who is building portfolio, or on the objective, or on the size of the portfolio, right? However, uh, metrics like Sharpe ratio, underwater plot, and all these metrics are usually going to be there. People usually start with there. At the same point, I would like every one of you to like not only look at these selected metrics, right? Whenever you simulate or backtest your portfolio, try to go ahead and try to get yourself as acquainted as you can with different distributions of the data during your backtesting period. So for example, one of the distribution that we see over here is the uh, distribution of the algorithms, right? And what we see over here is like it's like although the distribution is skewed to the right, but like maximum number of observations fall in the negative bin, right? Again, although it's like it is between like 0.02% to 0.01% bin, but it still falls in the negative bin, right? So the peak being negative side, although the tail is in the right side. Likewise, if I go and see the distribution of the daily PNL, this is what we see with regards to the algorithms, right? And we also see that although it is left sorry it's it is a uh, the tail is on the right hand side, but we still see the peak towards in the negative zone, right? So there are maximum instances which are making losses, okay, and there are like very few instances which are making money, and overall it ends up in a profitable strategy. So once you go ahead and once you study this kind of metrics of the distribution, you will get to know like depending on the phenomenon that you have selected, why those distribution come up in this way, right? So for each phenomenon the distribution would look very different, uh, and it is expected as well. Okay, not only these distributions or the parameters that we just saw over here, one thing that I particularly like to keep in mind is like how well stabilized my parameters are. Okay, so here what we see is the uh, different variations of the same portfolio for the same duration. So over here, these are just different backtesting results of the same idea with different parameters during the same period, right? And what we see over here is that we see quite similar numbers even in returns and even in drawdown, right? Now this tells me that okay, this phenomenon work, regardless of what parameter I am using. Okay, because the phenomenon itself is something that I can capitalize on. And even if I use any of these parameter combination, right, the chances are that it will make money going forward. Okay, so over here I'm looking for the parameter stability. It is also known as the stabilization of the parameters. So I'm not basically overfitting my data, or I am not overfitting my historical uh, numbers. Okay, what I get to see is that, okay, these are the numbers which are generating returns. If I select any one of them, the chances are that it will make similar things going forward. Of course, the backtesting results are not the uh, will not be replicated in the future, or are not something that, that we will get in the future, but we get a considerably good idea by looking at this parameter stability. Okay, so this is one thing that I would urge everyone to do whenever you backtest your portfolio, and see for the parameter stabilization. If you are getting consistent parameters, perfect. Some That is the idea that holds some value. Okay, now we backtested our strategy, we backtested our portfolio, and things look quite well, right? Now it's time to implement. So what are the things that we need to keep in mind when it comes to execution? So execution in and itself is a whole subject, not rather a topic, but it's a subject, or in itself, which is as important as ideating the whole portfolio. Okay, now when it comes to execution, usually among the LFT and the MFT players, it is the REST API that is being used across the industry and the retail players to connect to the exchange and to trade. Now REST API have become the industry standard in such a way that in today's time, any broker who provides the algorithmic trading facility uh, would support the REST API. So on this screen, we see like majority of the industry players across the regions who supports REST API. Now REST API is extensively used to automate stuff, to connect with the brokers or the exchanges and trade, right? And the good part is it is language agnostic, so one can go ahead and one can use any language of their choice to trade, with Python being the most popular one. Okay, and when it comes to HFT, there are usually two options. The one is this broker specific API, and the other one is the gold standard, which is the fix API. Almost everyone who are into HFT space would be using fix API to some extent to connect and to trade. Okay, so when it comes to execution, these are the ways that one should go ahead with. Now we talked about sourcing the idea, the objective, the diving deeper into that idea, backtesting them, executing them. Now, but I want to use machine learning. I want to use AI. Everyone is using AI like nowadays. Like again, so where could I use AI in this whole process, right? Like what are the ways I could make my portfolio different from the rest with the help of AI? Sure enough, so as much as AI making all the hype in other industry, it is equivalently making a hype in the finance industry, or I would say in the trading industry as well, and which could be used primarily into two ways. So the first way we could use machine learning models is to generate alpha. Okay, which in a sense is like we would go ahead and we would try to predict the direction of the market, or the predict the price of this instrument, right? Or to some extent we would say that we would try to predict the trend of the market. So if we are able to come up with a machine learning model that predicts the trend of the market, we could write that trend, right? So, or if we could say that, okay, this particular instrument is going to fall, or if this particular instrument is going to rise, we could build long short portfolios. Okay, so that is one of the applications that falls under the alpha generation category. Another one is the deriving prices of the derivative products, for example options, right? Now instead of like deriving option pricing using those traditional models like black shows and whatnot, we one could use machine learning models to come to derive those prices and use those models or to use those prices to compare with the market prices and see like if those prices are deviating. If they are deviating, take a position, back test it and see like how much they're deviating, and try to come up with a one could try to come up with a uh, system that if the price deviates quite much, positions are initiated. So this is the one of the ways to use AI to generate alpha. Another approach is to use machine learning as a meta model. Okay, and which is where the extensive research is on. The practitioners are focusing more on towards this side, which simply says that you keep your existing logic, existing core logic as it is, right? And you use machine learning on top of it. Okay, so to give you an example, say I have another system. Again, let's go with the RSI example only. Say I have a system wherein I go long when the RSI is above 50, I go short when the RSI is below 50. Okay, or the thresholds could be anything, right? Now whenever the RSI crosses the above threshold, right, before entering into the positions, I will first ask my machine learning model, should I enter into this trade? What are the chances that this trade will make profit? Okay, now these are the kind of models that one could use to reduce the whip shows, or to improve their winning rate, right? So these are the meta models, or these are the machine learning models that could act as a layer on top of the existing systems to further refine the trading systems and make the trading journey a bit smoother, right? So these are the ways in which machine learning models could also be used. The other examples that I have mentioned over here are the price optimizations, or the weights optimization in a portfolio building activity, wherein we say that in how much proportion we should invest in a particular instrument, and those weights come from the machine learning models, right? So these are the like overview, or these are the steps one could use in their journey, right? And they can to go ahead with like building their first steps, right? So this is what I had for you in the store. Now I will open the forum for the Q&A, right? Cool. Rohit, sorry, Rohan.
Hey, hi. Jay, thanks a lot for your awesome session. We had a lot of people asking questions and
Sure.
for recordings and scripts, etc. So just to let everyone know, you all will get the recording in a day from now. However, let's dive into some questions, Jay, that have come from you.
Mm-hmm.
Um, so one of the question by Tejeshwar Singh was, when you said about the strategies selections, are these just the few strategies or more common in the field or foundational strategies that you mentioned?
Oh, so this is what I actually meant to say. So when I mentioned strategies, right? I particularly mentioned these are not the strategies; these are the phenomenons. Okay, these are the phenomenons that exist in the market on a repetitive basis, based on which a business could be built, right? So, for example, arbitrage. So now I know that like if a particular instrument trades on multiple avenues, there could be chances that it could be available for cheaper on one avenue, it could be available for like higher price on another avenue, and this is a repetitive pattern, right, which I could capitalize on. Another phenomenon that I specifically mentioned about is the volatility, wherein we say that it is observed that realized volatility is usually lower than the implied volatility, right? So these are the phenomenons. Now strategy, I have used the word strategies because it goes by these names, or it is more common across the practitioners to use strategies, but I see these as the phenomenons, not as the strategies, right? Because strategies in and itself is like very generic term. So no, these are not strategies, these are the phenomenons that one could try to capture, right? And if we go to these research papers, we would find that, for example, betting against beta, or a profitable day trading strategy, right? So people often use strategy in multiple aspects. So these are not the strategies, but rather a phenomenon that one tries to access to, or one tries to capture.
Right. Yeah, that's correct. Because I think strategies, models, paradigms,
Yeah,
in
exactly.
different ways. All right, great. So there are a couple of questions which I think will get answered in the next or the following session by Tomás and Mrinall.
Hmm.
Uh, there was one question by Akshay Natu.
Okay.
Uh, if the peak is in negative range, how is the overall strategy profitable?
uh okay, so I believe the guy is referring over here, the over here we don't see peak in the negative range. So I believe he is referring to this part. So
Mhm.
this is the maximum drawdown, which is always reported as the negative number, right?
Mhm.
And the other thing that I now remember what he's mentioning is like this peak. Okay, so he's referring about this peak. So this is the histogram that we are seeing over here, Tejesh. Now, this histogram, as we see, if we combine the number of instances in the negative side and the positive side, the positive side instances would outweigh the negative numbers. Okay. Although the peak is in the negative side, the numbers would over here far outweigh far the negative side, and as a result, the overall system would be positive. Right. So again, it's the uh, we call it system expectancy, right? Although the peak is negative, the things are like, again, that does not determine the overall profitability of the systems. So in simpler words, it could be like we could say that there could be many instances of smaller losses, but there could be a fewer instances of like very big profitable trades, and as a result the overall strategy would be profitable.
Got it. Thanks, Jay. There are some questions on how can you explain in deep how strategies are made. I think Heath, that's a completely different session and a long session that Jay might have to take about how deep you can go into strategies. It's a never-ending pit.
Yeah.
Uh, so there's one question about how where can I get some historical data on derivatives and equities?
Hmm. I believe Quantra has a course on that. There is a whole dedicated course on that part. Probably someone from the team might want to refer to that course. It's a free course, by the way,
Right.
because it's a subject in its or in itself, right? So yeah.
Yes, that's true. Then let's take one more question.
Yep.
When you say using AI for trading, do you use any LLM or you build your own LM software on top of your code?
Not really. So LLMs are kind of a pretty new thing, I'd say. Uh, LLM in itself does not really understand the context. Okay,
Mhm.
so I have very limited experience with LLM, but I have never used LLM as such in trading strategies. Okay, because most of the time LLMs work with non-structural data quite well. However, what we work over here is like mostly structured data. Now, even if I think about parsing news data or any other thing, right? I don't think LLM would be required in that part. Yes, LLM could be required, or LLM could be used to help ideate the strategy, to help understand the phenomenon, to help to help I would say write code. But again, that doesn't mean like that code would be correct. Okay, but yeah. So LLM would act as an intelligent intern, so to speak. Okay, but it cannot do like your work.
Right.
Your work needs to be done by you only as a modeler, right? The LLM would help you to carry out those operational tasks.
Got it. Right. I think that caters to a lot. Jay, there are too many questions. I think we will not be able to do justice to time. But thank you again, Jay, for your time and thoughts that you have brought to the table. And I hope people gained a lot.
Thank you so much, Rohan, and I hope like people would have enjoyed this. And yeah, uh, like I did enjoy like basically going through this part, and I am pretty much obliged. Thank you, guys. Thank you very much, Rohan.
Thanks, Jay. Awesome. All right, so let's move to our next session, which is about hearing real stories, real shits, and career journeys by Mrinall and Tomás. Um, so before we get into that, I just want to introduce both the gentlemen. They come from their profound backgrounds. First, Mrinall Mahajan. Mrinall is Vice President BlackRock. I'm sure many know BlackRock, but and they are the world's largest asset management firm. His work involves quantitative strategy, risk modeling, and development of data-driven financial products. He's a IIT Kanpur graduate, certified FRM, Financial Risk Manager. Mrinall previously worked with MasterCard, American Express, and EXL. His journey into quantitative finance was shaped during his time with EPAT and colleagues during EPAT, where he built capstone projects and which now influences daily work in institutional finance. Joining him, we have got Tomás Garcia, a senior asset allocation strategist with Santander Asset Management. With nearly 2 decades of experience, Tomás combines macroeconomic research, AI-based modeling, and behavioral finance to create institutional investment strategies. He is a CFA, CAIA charter holder, and of course, an EPAT alumnus. His academic background spans law, financial markets, economic analysis, giving him a unique lens through which he approaches multi-asset investment and quant research. And together, of course, with me moderating, we will try to walk you through their motivation, their decision making when switching to quant roles, their capstone projects during the EPAT program, and of course, there are challenges that they face during the transition. Someone in the questions mentioned, no journey is smooth, no strategy is accurate. I mean, yeah, of course, everything has its own challenges, so we'll come through that. And of course, how EPAT and QuantInsti help them shape their high-level quant positions. So, welcome, Mrinall and Tomás. Thank you for your time and joining in.
Thanks for having us here, Ram.
Thank
Awesome.
you. Proud to be here.
Lovely. So, Mrinall, Tomás, let's go through certain questions that we have received and we have been getting for some time for different participants, including you, which will help us understand how y'all have transitioned, transformed, evolved, whatever you call it, your journey through the entire pace of time, right? So, let us start maybe with both of you all, one after the other. At at what point did you all realize that a data-driven, systematic approach to trading was a smarter path than relying on emotions and institutions? Mrinall, you want to go first?
Sure. So I guess that one is a pretty no-brainer. So I come from a sort of an academic background where it's just statistics, mathematics is quite aggressively pursued. So for me, when I started my personal investing journey, even then I used to do at least maybe a basic due diligence around some ratios. I do used to read about what should I look for when, let's say, investing in a firm. Um, so that kind of comes naturally when we say that, okay, we have to make a decision on the basis of a certain data, right? Because you have got your money involved there. So for me, it happened very naturally because it was my own personal money at first, which was involved. But then, yeah, afterwards, how does this whole automation part and, good big coding and everything comes into picture? That's I guess precisely when I thought of it as a way as a career to pursue. So back in the day, I was into credit card analytics predominantly. So I was working on fraud modeling, on creating marketing models for credit cards. But I had a big interest into finance. I always wanted to pursue the overall financial markets. So I start and with keeping that along with let's say making investing a bit, making up some putting your money to work. So there I thought that and I was the kind of person who wouldn't really like, okay, just to put up the money and forget for, let's say, 5 years. Or I was someone who would, let's say, look every 2 3 days that, okay, how is it doing, is it growing, is it there's some losses. So that's where I believe my kind of aptitude comes in. So I was more of an I would say a trader aptitude. And when I thought about it, it comes to me that, okay, considering that I have a bit of a full-time job and everything, I can't really stay on the screen. So I have to find something that through which I can automate much of this stuff through some strategy that I could build on. And that's where, this whole data-driven thing clicked, that, need to pursue it in a very, very systematic way to proceed ahead.
Makes sense. And I think that is one of the very prominent challenges that I cannot sit in front of the screen very often. And so, yeah, thanks, Mrinal. Tomás, do you want to add to your story on that?
Yeah, for me, it wasn't one specific point or market event. It was a gradual realization built over many trades. So, from the very start of my career in financial markets, I felt like two different people. So, when analyzing the market, I was like Dr. Jekyll, a reliable mathematician, precise, logical. But when I actually traded, I became Mr. Hyde, a bundle of nerves, making lots of emotional mistakes. And at the beginning, I didn't understand why this happened. My analysis was solid, but my execution was weak. It was ruined by stress, impulse decisions, separating from my plan, etc. So, firstly, studying behavioral finance helped me understand why this Mr. Hyde appeared. But understanding wasn't enough. I needed a solution. So that's when I turned seriously to quantitative methods. Um, Building rule-based systems empowered my Dr. Jekyll inside, forcing consistency, removing cognitive biases, attenuate emotional decisions. So all of this made dealing with this with my Mr. Hyde much easier. I think that it was a smarter path for achieving repeatable results. However, I want to add two important points here because I think that it's important to make this clear from the beginning. So, first, even the best of the quantitative systems can have the emotional biases of its creator inside. But secondly, and here comes the good news, while I strongly believe in data-driven analysis, I don't think intuition or emotions are useless. So research like Kandasamy in 2016 shows that certain types of intuition developed through experience can have value under stress. So the key is balance. You don't have the need to eliminate the human, and you'd better maintain the good human, the best yourself, your Dr. Jekyll. So the best thing you can add to any quantitative model is you, but the discipline, experience, objective you.
Makes sense, Thomas. I think the analogy of Dr. Jekyll and Hyde really plays well. And a very interesting point that you mentioned, that you need not get rid of the human side of you. You can still have the good part of it and still continue. Makes sense. Thank you. Before we go ahead, thank you guys for the Q&A. We have just crossed around 120 questions already. So yeah, we'll come to that. I still encourage you to add questions. I will still add, Mohit, if you could just push a link to the Calendly if people want to ask more questions. That is for Jay, which I can see. They can possibly book a slot to get answering call by the faculty through our counselors. Awesome. Let's continue. Let's go to Mrinall. Mrinall, your EPAT project focused on dynamic asset allocation, I think, with neural networks. What problem were you trying to solve, and what was the structure that you put into work?
Yeah, so the basic whole motivation for this problem statement was that what I believe, and probably what's actually the case, is that the market are very dynamic. They don't stay the same way. And most of the algorithms that probably I knew back in the day were static ones. So let's say your machine learning algorithms, gradient boosting, random forest, all these are quite good, but the only problem with them is that you will train them on a specific period of data, and then they stay that way. You can't really keep on feeding the data to them, right? So that's where this idea hits me, that I'm going to do some bit of trading on my own, and I have to create something that could reflect the actual daily ongoing dynamics in the market. So the best way I felt that at that time to approach this was using a neural network. So what this used to do is it was a returns predictor. So it gave me like, I have a set of I guess back in the day I just used the banking stocks, the ones that used to trade on the Nifty Bank Index, and I was just trading them. Like, it was a kind of strategy wherein, let's say I have the returns, I have some returns assumptions, and on the basis of the prior returns, I do know that, okay, this is probably going to be the risk based on the last few day returns. And so I can calculate some ratios and distribute, let's say whatever small amount of money I'm investing on a given day on the basis of whatever ratios I get. And day on day, if I felt, okay, something is gonna fall, I would probably reduce my allocation into that particular stock for that day. So it was kind of a daily kind of a strategy. And my motivation for that was that, okay, I need to buy it, let's say, at the open of the market. So I buy it, and the next day only I'm going to get to know, okay, what happened. So on a daily basis, I can kind of make it a habit and invest some. So you can consider it as a kind of a daily SIP thing, if you may say. So that was, I guess, predominantly my motivation back in the day. So it was a kind of for a personal and practical use, much more than just for the academics sort of purposes at that point.
Got it. So basically you answered my question. So this was more daily dynamism that crept into.
Yes.
Okay. Lovely. Thanks for that. I mean, this is, according to me, I've not come across this combination very frequently, but that's lovely to know. Tomás, you have studied behavioral finance, right? How did you translate those insights into your current work profile or work routine?
I approached this through interconnected views of behavioral finance. First, micro behavioral finance, which means studying how cognitive and emotional biases affect us as traders. And here, quantitative methods are powerful because they almost eliminate cognitive biases. Like, for example, overconfidence in patterns, anchoring, status quo, all of this can be removed, mostly removed. The problem is sometimes emotional biases. They are trickier. They can enter inside the systems, but fortunately, this isn't always bad, as I said at the beginning. For example, it can be something intentionally. Um, my natural loss aversion might lead me to overweight risks in assets with negative skew, with asymmetric downsides. In a system, that becomes a conscious rule, like reducing position size for tail risk assets. Um, it may lower returns in good times, but it acts like an emotional airbag, preventing big drawdowns or martingale-like return curves. The other view of behavioral finance is macro behavioral finance. Studying how these biases, I just talked about, the micro behavioral finance biases, how these micro behavioral biases create predictable patterns. And this is pure signal generation territory. For instance, we can transform news headlines into systematic sentiment indicators, which is a technique QuantInsti knows really well, or we might quantify sentiment streams, converting flows, options, and future positioning, etc., into scoring systems. For example, panic signals when all indicators align, etc., or seasonal patterns, backtesting consistent anomalies like the Halloween effect, the selling May effect, or US election cycles, and then encoding them as calendar-based rules. So here, behavioral finance became more than just about removing bias, which, which is also something that you can do, but it's more than that. It's about finding the power of behavioral finance systematically.
Got it. Yes, I think it's also about including that certain small biases of macros. I mean,
Mhm.
awesome. All right. So this question is to both. What were the steepest learning curves while you were building your strategies? This time, maybe I can go with Thomas first, if that is okay. So, what were your steepest learning curves, Thomas, while you initially actually started building strategies?
It's a good question. So looking back, I group the challenge into three key areas. Yeah, three key areas. First, mathematical models, coding, and data management. Regarding mathematical models, were at the beginning, I remember perfectly, were initially really intimidating. Like concepts like black source or combinatory, some statistics, machine learning, felt like climbing mountains. The
Right.
equations looked complex, and I was worried that my non-scientific background, like many here probably, would block me. But here are again the good news. With practical application, this all that you know become accessible. Then, secondly, the coding. So it seemed like the biggest hurdle early on, but it became the easiest part of the long term. Modern Python libraries, the help of IA, clear documentation, all of this turn implementation into an easy process once fundamentals are solid. And, um, and the third one is that data management, which remains my most difficult and probably most critical challenge. This is where real quant work lives, cleaning messy real world data, gaps, errors, corporate actions, validating against multiple sources, for example, comparing EPS data from IBES, from FactSet, from Bloomberg, maintaining bias-free databases, like removing look-ahead bias, etc. All of this, it's not glamorous, but really an extremely important.
Sure, makes sense. And I think, I mean, it is not that glamorous generally when you get into it, but yeah, things do ease out. Mrinall, you want to add your 2 cents to the question?
So for me, like my approach before getting into finance and even now is less on the strategic side rather than developing models or products which help predict several aspects of a security. But in terms of, let's say, the steep learning curve, one thing that I pretty much learned a bit quite quickly is the stop losses and the transaction costs. So while so if you backtest your strategy, while it may look like, oh wow, it's working so well, every day I just buy it and the next day I sell it. It's looking, but what you don't realize is back in the day, if you sell it within a short period of time, there's an attached cost to it. So that's where your returns are kind of take a bit of a backseat. So that I pretty much learned when I went into the practical application. Once I started executing things, that's when it hits me that okay, what was expected, it's probably a few whips lesser than that, considering okay, these are the costs involved when I'm trading. Um, in terms of I guess in terms of other things, probably back in the day, the only aspect of a security that I consider was returns. So it was all about okay, what's the returns, what's the this, that's pretty much it. Once I probably entered more formally into the finance space, I get to know about there's a lot more than that. There's a liquidity risk involved. There are volumes. There are similarly this cost that I thought that okay, something like this could also be modeled, to predict. So that's, I believe, from the past like an year or so, has been one of my steepest learning curve in terms of understanding all the new aspects, of an asset.
Got it. Makes sense. Thanks, Mrinall. Uh, okay, so coming to, so actually there was a question about the blind spots that you faced around your own assumptions that you took. So when you actually got, so of course, Mrinal, you did mention about the trading costs involved end to end, which you overlooked initially. But other than that, do you see any blind spots that came in once you started your journey hands-on?
Yeah, so as probably Thomas also mentioned, even though let's say sometimes your strategy might say, to probably act in a certain manner, you have certain emotional value attached to whatever, investments or whatever set of portfolio you have got in a while. So it's been these are some of the blind spots that I had. Like okay, even if maybe the strategy is saying a certain way, I kind of maybe override it if I feel that okay, maybe not now, not the right time to do that. But yeah, I feel the best way is just follow whatever strategy you have. If you have a strong confidence around that, it's back tested, it's going you have your confidence around its withdrawal and everything. And yeah, so that's like pretty much what I can say about a bit of a blind spot that I faced.
Got it. Thomas, anything apart from what you mentioned as a blind spot that comes, I mean, something that came as a jerk to you when you're hands-on?
Well, I could add more about what I said, but I think that that my most important finding is that one of the biggest mistakes
Mhm.
is trusting elegant math over market reality. So early on, I assumed that complex models would guarantee success, but reality taught me some harsh lessons. First, mathematical perfection doesn't exist. Second, and it's a lesson related with this one, complexity feeds fragility. So using PCA or machine learning can unintentionally obscure the logic behind the strategy, creating black boxes. Also, the data is as important as the model, maybe more. Garbage in, no matter the model garbage out. And finally, other important lesson is that you have to realize that markets evolve. So static models die. Relationship between variables shift, and a source of alpha that worked in 2019 may fail the next month. So backtesting without regime analysis is like using a map from another century. I think that it's worth to remember models or mathematics are the mediums, are the tools, but not the end of the path, and definitely not oracles.
Right, true. I mean, I think with the 10, 11 years with the industry and QuantInsti, have faced this question or skepticism a lot. Static strategies and how well they work. So thank you, Thomas, for bringing that to a point. Looking back at your EPAT journey, what parts of the program actually was the most valuable? And what features really kicked in during the journey? I will keep it open for you all to pick and choose who goes first. Let me make it a little complex for you both.
Okay. Okay, I guess I can go first.
Thanks.
So for me, definitely the project that I did was, one of the finest parts of my EPAT journey. So it kind of culminates everything that, let's say, you have learned around the past 7, 8 months into, one bit of thing that you can finally use, or you have something, let's say, to show up, right? That, okay, this is, what I've learned over, not to show up, let's say, to the fellow folks, but just to yourself, that, okay, I have learned something that's, quite worthwhile. It is something that could really, make up some money out of the skill set that's been gained. And within that, I guess, so my mentor, Mr. Gaurav Singh, was a very fine gentleman. So I had happened to develop, quite a good connections within, the industry. So even with some of my batchmates, so I was able to interact a bit and get to know, okay, how's everyone doing, and what are, the different areas that one has been working on. So I guess it kind of widened my exposure to the industry a lot. Before that, it might have been that, I was very constrained towards just, okay, this is what I have to do, this is what I have to focus on. But it kind of opens me up to a lot of new areas. So, like, back in the day, it might have been just, let's say, equities. So one might not know about, okay, what are the other options? Forget about the equities. I didn't know about the options as well, right? So it introduced me to the world of options, futures. So that's where, and not in a very, I would say, what people would call, in a manner of like taking an uncalculated risk, taking a bit of a gamble, but taking up very, very calculated, very, very conservative risks. So I believe that kind of really helped me, both in my personal as well as professional journey.
Awesome. Thanks, Mrinall, for the kind words. Thomas?
So look, having complete the CFA, the CAIA, the CAIA, 2 master's degrees, etc., I can confidently say that EPAT stands out as one of the most impactful programs I've ever taken. Unlike theory-heavy courses, EPAT throws you into the real world since the beginning. I never forget, by the first class, we've just started building a trading strategy in Excel. No warm up, no pause, just immediate real world application. This hands-on from minute one approach forced me to use concepts and not just memorize them. Regarding the faculty, they aren't just academics, they're practicing quants, fund managers, trading desk veterans. For learning volatility models from someone who trades them daily, it's priceless. Their real world stories and feedback turned complex theory into actionable knowledge. Here I'm thinking about, for example, about the option lessons that were superb. And finally, I think it's worth to be mentioned the tribe of passionate peers. EPAT connects you with people fighting with the same coding hurdles, the same backtesting puzzles you are. So for anyone serious about quant finance, I think that EPAT isn't just education, it's a career accelerator, and I recommend it whenever I can.
Thank you, Tomás, for the kind words. Yeah, I mean, it's good to hear what we were trying to achieve. We have been able to achieve to an extent, and putting the program together in the right sense. Thank you for that. So from EPAT up to your current profiles, considering both large organizations, Santander and BlackRock, when you have a fresh data-driven idea, what steps do you take to move it from, say, a concept, a rough idea, to a real life use, real world use? Tomás, you want to go first, maybe? Oh, sorry, Mrinall, you did unmute. I'll let you go.
Okay. Yeah. So I guess for me, the way it works is that so if I have an idea, I immediately discuss it first with my peers. That that's I guess the best way to go about it. So you have some idea that okay, maybe we could predict something like in a certain manner in this way, or maybe a new algorithm, or maybe a new strategy for that matter, and a new application of a certain model predictions, whatever. The best way around is to go consult with your peers, and these peers could be someone who is, let's say, very active in that particular asset class, which immediately needs that sort of a strategy, or someone let's say who maybe not is that active, but let's say whosoever is in your contact first, right? So whosoever best. So maybe first have a bit of a validation, get some sort of a validation. I guess it helps both, it helps you more that you kind of develop some sense of confidence in that idea. Once, let's say, you develop some sense of confidence, build a basic proof of concept around it, that maybe don't take up too large timelines. Maybe take up a month or 3 months, whatever, quarter, whichever you feel is a comfortable amount of data. So try to see that whatever you have built up on that small set of portion, on that small set of time period, is that making any sense? Is that giving you some edge on the existing methodology? So if once you have that, then maybe it's the best time to kind of put it up in open and say, hey, this is what something we have done. We can further improve it, or with some because proof of concept needs to be quick. One thing that I always say, you can't really invest a lot of time on proof of concept. It needs to be very small, so short and sweet and quick. So once you have some confidence around, okay, this thing is working, go to the people who you feel are going to be either user of it, or ask yourself, if you are yourself, someone who might use it for your own use cases, ask yourself, okay, can I, is it, something that I can use? And there are two parts to it. One is, of course, the monetary impact, that okay, how much. Second thing that also matters is your comfort level to use it. So is it something, so let's say if I build up something that maybe have some bit of a monetary edge, but maybe it's just completely inexplainable. If someday something goes wrong, I don't know how to investigate that thing within my product. So I believe for that, you need to consider all those dimensions. That am I comfortable with that? is the user who I'm proposing this, is he or she going to be comfortable with that? So considering all these 2-3 dimensions, I guess then one should really proceed with giving it a very a long time investment, long of your time. So like that's how I generally proceed in my in the professional space.
Makes sense. Thanks, Mrinall. And Tomás, with you at Santander?
I think that, well, measuring the success of new strategies, or this requires a strict review process, not just by yourself, but as it has been said, but through critical peer review with participants actively hunting for errors. I won't elaborate extensively, because that's a whole webinar itself, probably. But I would say that the key point is beyond concrete metrics, which also matter.
Yeah.
The main point here is that your model must be understandable and future-proof. First, so I would focus on two negotiable pillars. Beyond standard metrics like Sharpe ratio or drawdown, which are also important, don't get me wrong, but more important is the explain and diagnose rule. So can I clearly explain why the strategy works in simple terms? Can I diagnose exactly why it loses money in some periods, in some concrete periods? If I can't teach this to a critical peer in 5 minutes, it fails. And the second pillar is the future survival test. This is based on Andrew Law's adaptive markets theory. So why will this keep working? Because, for example, it exploit persistent behavioral bias, X, whatever. So how this it survive in high volatility regimes, in recessions, in low volume markets, or what market change would break the strategy? For example, if central banks do something, then we should exit. So past performance is history, and it's important to, of course, to look at the past. But if I can prove why this lives tomorrow, no backtest is interesting.
True. I think you both answered to an extent about one being comfort level to the strategy, and then comfort level will only come when you can answer critical questions about that strategy, whether is it future proof, can I answer all the questions around it, so on and so forth. So thanks for that. We'll pick one quick question before we close this particular session, before we get into the EPAT details. Markets evolve quickly, that you have been saying, Thomas, for a couple of answers now. What habits and resources have helped you to keep up with the new techniques, market dynamics, etc.? Thomas, would you want to go first?
Yeah. So one truth anchors everything, and it is the only constant is change. You can't stop. There is no equilibrium. You are always inside the sea, creating habits to surf the waves when they come, and they'll come. So saying that, here's some of the habits that I have. For example, first, I treat learning like breathing. So morning blogs, papers from different institutions, different papers saying the same thing but from different point of views, research, etc. Second, I lean on my drive. Coffees with colleagues, debates with PMs. This is not networking. This is early warning systems. Third, I play in the lab. New Python library, I break it prototyping one idea. And also, in the same way, I try to learn new statistical concepts while doing it. For example, coding it. Regarding education or certifications, I think that they are just pit stops, not the journey. So I take courses when tools shift, not just to collect budgets. And yeah, the main thing here is never stop. In markets, standing still isn't stability, it's surrender.
Got it. That's true. That's true. While we are on this, Thomas, I'm clubbing the last question along. I mean, of course, this itself is a suggestion and a recommendation, but as you know, a lot of people are getting into this domain. Any uh, comments or suggestions from you that people should take up? Any practical tip that comes your way? You're on mute, Thomas.
Sorry. So the question is about tips from the ones who want to sell strategies, for example, or are you asking about the ones who want to start the journey
People who
in
are getting into this domain of managing quant portfolios, etc.
Yeah, it's interesting. I've seen in the Q&A in the chat that someone asked about what can I do if I'm not from the financial or the quantitative field, if I have a different background. And I was thinking that I would say him, take the leap now. So if you have realized that market demand adaptation, that's half of the battle. So you need the other half. It's important to understand that your past experience is an advantage. So you are not starting from zero. Whether you are macro, fundamental analysis, psychologist, whatever, your domain knowledge cares. And quant tools are going to amplify your edge. They are going to create a better you. They are going to create like a superpowered you. Regarding coding or math, it's less than you think. So coding is like a language. You are going to learn by doing, not memorizing, and you can take advantage of that, like learning concepts while you are coding. So coding the new concept that you are learning. So build a seasonal strategy in Excel, code a basic momentum screener, test behavioral biases, code an optimizator, whatever. These are going to be small wins, and they are going to build you confidence and reveal the quant power.
Thanks, Tomas. Mrinall, sorry to keep you waiting, but the two questions that I combined, uh, one was about markets to evolve quickly, and how do you take up what are the habits that help you out?
So for me, my job profile is such that even if market changes, it's like I don't have to really do anything. People come up and say, "Hey, why is it not working that well that it used to be?" So in my case, the way I try to just stay a bit sane is keep myself updated, with whatever new is happening. Try to maybe read the newspaper uh, in the morning a bit, mostly Economic Times. Follow up on if there are any summaries of the latest news that are available. So that kinds of keep me updated with any immediate changes. Besides that, obviously, whenever the change happens, there are people who just come up and just inform. So then so the best thing that I have noticed is, so back in so early on, I used to get a bit scared when suddenly what happened, why is the things are not working suddenly. But now I have kind of developed some sense of calm towards it. Now the way I approach it is, I go to whatever is the scenario. I take a look at, how different is it from what it used to be back when it was normal. Then I try to see, what are the adjustments that I can immediately make to give some sense of relief that, now let's say with this some sense of adjustment, which is very, very a manual adjustment, if you might say. Maybe it comes up with a kind of a pinch of salt that, okay, later in the future, we will probably do something to make it a bit more, automated stuff. But yeah, that's how it pretty much works when it comes to change. Um, Other than, sorry, what was the other question?
It was about any practical suggestion for people who are getting into this domain.
Just be very, very patient. Backtest a lot. So don't really come up with the when you're backtesting, and keep it quite a good time period, the time horizon that you're looking for. If you're looking for implementing some stuff. And yeah, just see this. The field is so much evolving in a way that you have to keep on learning. So there is kind of no stoppage to that. So you have to keep yourself a bit open to, if there is some change coming up, some new technology coming up. You have to keep yourself open to, learning it, to setting up your time to, keep that extra time apart from your whatever day-to-day work is, to keep yourself upgraded on that. Because somewhere down the line, that thing is going to, give you an edge in terms of the overall market. So yeah.
Thanks a lot, Mrinall and Thomas. I think that was the questions that we had. We'll just take one question. I think I was looking at taking three, but we are overboard on time. So one of the questions which I think, Thomas, you answered of Mr. Kadam was, I'm a fresher in stock trading, want to enroll full course. I don't have the coding knowledge, which I think, Thomas, you did answer about any background that you have, any experience which is the highest is a win, right? But there was one question which is interesting. Anyone who would want to take it up. Up to what extent does game theory hold good? Does anyone want to cater to that? I'll keep it open. That's fine.
Sorry, can you please repeat the question?
It is up to what extent does game theory hold good?
Okay.
If it is,
I don't think I would be the best person to answer that. So I really have I don't think I have kind of a background around the game theory as such.
No worries at all. Great. Okay, Thomas, we shall let it. You would want to cater to that?
I just add here that this needs again a whole webinar itself to answer this question about game theory, because game theory have a lot of ramification. So if the question is, do we use game theory at work? I would say yes, sometimes, but it depends, because as I say, game theory have some ramification. But I don't know if I understand well the question, but we have to use it. For example, in geopolitical scenarios, we use game theory. In macroeconomic scenarios, we are living in the world of game theory. For example, we are now under the new U.S. administration. Game theory makes a lot of sense. So trying to understand it, etc., and using it to your analysis, probably it's interesting. But as I say, there are a lot of games that you can play. So it depends.
Thanks, Thomas and Mrinall. There are some questions which I think I can take care of eventually in the session next. I'm very appreciative of the fact that you all have been able to help us with the time and effort on this one. Thanks again, and we'll speak soon.
Thank you.
Thank you.
Take care. Bye-bye. All right. As we move into the final 20 minutes of this session, there are a lot of questions. There was one from Sushant. Can someone answer the question? And Sushant, I think your question was more towards understanding certain tools and alphas. I think Mohit had, it's too huge a concept. So Mohit, if you can share a link with Sushant Mishra to possibly book or schedule a conversation, that would be great. We have had a lot of questions around how to learn what Tomás and Mrinall have discussed across. And we will be getting into that part now. And I will try to cater to those questions on the side. We had some questions from Venkatesh, what laptop configuration and minimum features are required. Venkatesh, if you can write to one of our email IDs or with one of our counselors, they would be able to help you. We have a set pattern. It's not very robust, so you can surely get into. Rohan Vinod asked this question about getting into as a mathematical degree, such as mechanical engineering. Would you suggest what would you suggest to increase employability in the quant world? I'm very happy that you asked this question, Rohan. There are a lot of certification, including EPAT, which handholds you with practical aspects and helps you with getting opportunities in the industry in the professional quant world. So again, we can help you with a one-on-one catering to your questions. Now let's go through quickly. We have very little time and I don't want you all to spend more time than allotted, right? So having said that, why people are getting into this domain, and yet there are certain pain points faced by aspirants. The major pain points that are faced by aspirants of this domain are people do not understand how to bridge the gap. Like now we had a gentleman asking about the mechanical engineering and how do I build the gap, or someone earlier asked that I am new to coding, right? And how do I bridge the gap? So that lack of knowledge between technology and finance is one. How to transition from discretionary trading, I call it conventional trading, to more systematic approaches. People do not have very easy access to quality training and resources. Unreasonable expectation. We had a question about showcase how your institute gets the alpha and what alpha does it make, right? The main reason is people are looking at, as Mrinall mentioned, that people generally focus on the output of things, right? And not on the risk management, the predictability of the strategy, how sure are you with the forecast, etc. So unreasonable expectation, dedication and willingness to learn and upskill, and understanding the regulatory framework. Like currently, of course, across the globe has been changing a lot, especially very recently, India has had a renewed framework for retail traders. So understanding, and how many of us actually understand the changing dynamics of retail trading in quant and algos, right? So, which is quite dynamic now. Having said that, we have been working around the EPAT program to make it very, very current industry friendly and catering to these pain points, right? So the key reason why EPAT exists is because we want to fill the gap between conceptual learning, theory learning, and actual applicability of what you learn in the program, right? So while the entire industry is very beautifully working towards the concepts, the theory, we are trying to cater to the applicability and practical standpoint. If you have seen with the faculty pool that we have got, the very currently applicable strategies, 10 to 11 currently applicable strategy or paradigms, and platforms and data and tools that we cover in the EPAT program. The key highlights, if people do not know the EPAT program, it's a live lecture format. It is only solely built keeping in mind time of working professionals, full-time traders, and full-time students, and people who are even working in other domains, so that it's only catered over the weekend. And it's live, online, and lifelong, catering to access and support provided lifelong. We have continuous access to the lectures. One is during the session, and one is after the program ends. So during EPAT journey, and as an alumnus, you have got lifelong access. And as I think Mrinall or Tomás mentioned, you can always go back and refer to what you are learning. So the next question that one of the attendees asked is, will I be able to cope up, right? So with keeping that in mind, we have got a dedicated point of contact, which is called the support manager or support engineer, who will be there 7 days a week with you. So whenever you have a question, you have got human-to-human connect, and so that you can resolve your queries. From queries, we have got live doubt-solving sessions even in between different modules. We have a very strong escalation matrix, which is the support matrix. So we have got a so as it is a weekend-only lecture, before you get into any particular weekend, you will have some pre-reads, some warm-ups, and before you attend live lectures. And after the lectures, you will have actual quizzes and assignments for us to understand how well you have grasped the content. How well are you able to apply what you have learned on the platforms that are provided in the environment. And of course, like I said, the faculty members, one of the very key aspects of the program, these are current industry practitioners across 7 countries, including Canada, US, Germany, Singapore, India, Australia, right? Now, these are the typical, so because it is a certification program and it is recognized by multiple bodies like GARP, Global Association of Risk Professionals in the US, CPD, I saw a lot of people, participants from London, so CPD UK, and of course, one of our top contributing countries, which is Singapore, so IBF Singapore, that we are accredited by. And because of this kind of accreditation, and even now in the panel of 2, we had got 2 different backgrounds and profiles, the audience is very diverse. So you might have a CXO from a large bank, or a Bachelor of Arts, or a dentist, or a pilot, or etc., who is coming from a completely different background, but is a trader. And keeping this diverse nature, the curriculum is built, which also holds a place where we start from primers. So anyone who is interested in the program, and as and when he or she enrolls, there is a pre-batch module, which we call the primers. So if you're coming from a non-programming background, you will have certain warm-ups or certain modules or lectures or sessions before the batch starts. If you are coming from a hyper-tech background but have got no understanding of financial markets, the primer consists of certain parts which caters to your basic needs of understanding finance, so on and so forth, right? And then you have got a small element where you have got entrepreneurs, so people who want to move their working professional life to a friends and family money management business, or from a friends and family money management to, say, a market money management, right? Let's have, now that we have discussed the type of audiences that we have got, Mohit, if you can release the first poll, I would like to understand what is the comprehension of this particular congregation, if I may call it. So please help me understand from what backgrounds and how do you really describe yourself the best? We will hold it for 5 seconds. Mohit, you might also might have to share the result as and when. We'll hold it for another 5 seconds. So this will help me understand package or put the right content in front of you basis the audience today, right? Mohit, let's end it in a couple of seconds. Thank you. So maybe I think everyone can see the poll. So like I said, it's diverse, one. Second, it's a very nice balance between programmers, retail traders, and others, right? And we will have, so professional trader and portfolio fund manager, I will take it as a combination. Generally, both land in the similar bracket. And then, of course, analyst, and this can be any kind of an analyst, right? Let's end the poll. I think we are at a 52%. I'll encourage people to reach 60% if you don't want me to prolong the session. Can we have a few more participants here, please? Awesome. Cool. I think we can end it. We are at 55%. Mohit. Thank you for that. Thanks, Mohit, for making me the host. I can get it now. Awesome. So here we are. So we have gone through, we have understood that we have got retail traders, programmers and techies, and we have got others, right? So which takes me to this slide, okay, which is the EPAT flow. So this is like a pictorial representation of the entire program, right? So it's a 6-month program, weekend only, catering to all three foundation of fundamentals, which are stat math analytics, programming, and financial markets. So like I said, the first part is the primers, which is a pre-batch module, so that any gap that you have gets fixed even before you start off the batch. So that you come, even if you come from a different background, you are quite well equipped to complete the program, right? Then the first part is laying the foundation. It's laying the foundation is not just before the batch. It is all the skills and learnings that you would require before you get into building models, building concepts, or executing your back tests, etc. So straight from as basic as building your trading psychology, like Tomás mentioned about that humanness, if I may call it, is essential. Macroeconomics, the basics of stock markets, basics of Excel stats, Python, and then understanding of the market microstructure, order book management, how to structure. You'll be dealing with a lot of data, right? So how to structure this database, how are different investment funds structured, and as deep as getting into objective-oriented programming, so that you understand that all these bits before you delve into the modeling or the concept building. Mind you, it's not necessary that this is going to be a one after the other. There'll be some backtesting which can be done at before reaching the OOPS modeling, right? The object-oriented programming. So, but the necessary skill sets will be built even before you get into basic strategies like utilizing indicators in quantitative approaches. So from there on, we cover around 10 to 12 different strategy paradigms, straight from indicators, price action, momentum-based, trend-following strategies, pairs, statistical arbitrages. If you want to dive deeper into the concepts, then intermarkets arbitrages, machine learning concepts, neural networks. We discussed with our alumni about sentiment analysis or NLP, reinforcement learning. And then you see the small pockets of options, futures, stocks, and exchange traded funds, ETFs, where these are specific strategy paradigms for those instruments, right? So we are catering to those nuances and the large chunk which are in the center, which are asset class agnostic. You can apply this to low volatility funds also, like fixed income, debt, bonds, investment management strategies, etc. So once you're done with fundamentals, build your strategy paradigms, understand concepts, blah, 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 we get into how to create your portfolio. Now, portfolio about how to asset allocation, like Mrinall mentioned about dynamic asset allocation, right, by the day. Then to get into portfolio optimization, and then dive further into risk mitigation and risk drawdowns. There was a question when Jay was talking about how to minimize drawdowns. So we very evidently cover this in the module of portfolio optimization and asset allocation in EPAT, right? So anyone who has a question around that, please feel free to ask those. Once we go through that, we get into backtesting. We heard this term multiple times by all three of our panelists today. We believe a lot in backtesting and doing this again and again, but as Tomás mentioned, you can backtest this how much ever you want, but there will be a certain level of predictability that you will want to build in your models, right? And here we try to cover all types of backtests: Excel-based, Python-based, platform-driven, that is trading platform-driven, and visual coding. Excel-based is done at the very initial phase, and then, of course, we inject Python as a very easy means to the end. We have a dedicated module on how to set up your own desk. We saw there was a decent chunk of retail traders. So people who are transitioning from retail, conventional trade. When I say retail, when I'm talking about your technical analysis, or transition from technical analysis to quant approaches. You will also need to set up or change or evolve your desk, be it your latency management, your infrastructure, your system architecture, etc. So we have a dedicated module which caters to complete life cycle of how to set up your own desk, straight from business environment, regulatory framework, resources required, what frequency you are going to trade, low frequency, medium frequency, high frequency. So we cover that. We also cover, like I mentioned, a lot of platforms, right? So Interactive Brokers, Zerodha, Upstocks, Alpaca for US. We cover, we can connect with REST API, TD Ameritrade, Robinhood, etc. And we also can help you or guide you or train you on how to create your environment on cloud, right? So we can utilize AWS, Amazon Web Services, and go on from there to help you from there to create a more seamless environment for yourself. We also focus on execution strategies, which was a part that Mrinall mentioned, that he has been backtesting, created a lot of strategies. Everything looked hunky-dory, but when it came to execution, there was a decent learning curve. So we also cover execution strategies and codes that can help you go live, at least with paper trade, quite easily. And then with your own learning curve, you go on to your actual live trading. Right, so that was certain key takeaways that you would be going through. Now, a typical journey, which we already face, is at the bottom line, is to set up your own desk or work as a quant and algo, right? So the entire journey, of course, it was pictorial, and now I want to go as a flowchart very quickly. Build your basic foundation, that is primers, help you understand data sets, create an analytical bent, build a quant perspective, so as I think Tomás mentioned, there are a lot of tools which will help you grasp the programming language, the environment, the tech very easily, right? So we include those environments which are plug and play, and that can help you get a better learning curve, shorter one. Strategy modeling, we covered those 10 to 11 different paradigms, and a portfolio management, research and backtesting, risk management, execution, and one thing that we missed was post-trade analytics. So something that makes you go back to the drawing board and come up with those analytics. At the end, we have the project work that we discussed of Mrinall and Tomás. This is a blank canvas. So you learn everything, but you want to create a working model, where the intellectual property should belong to you. So this is your blank canvas. You can call it a final project, a capstone project. And here you can select an asset class and or a strategy type. And in that combination, we'll allocate a mentor or a faculty or a teaching assistant. And together, you all will go through the entire life cycle of the strategy, right? So building the concept, taking that to a code, taking the code to a platform or an interface, to a backtesting environment, come up with the backtesting results. The key role of the mentor is helping you to optimize those results. And you can also test this in simulated environments. And the intellectual property, as I mentioned, belongs to the participant. So you can repurpose that however you want in your working lives or your own trading lives, right? And these are the most appreciated aspects of the program. So you might have got some whiff of it while we had this session, but something that I would want you to read about if you have not is the most comprehensive curriculum. Of course, we went through, but I don't want you to wanted to take you through something which is already there on the website. So maybe the curriculum would be very hands-on. So Mohit, I don't know if you can post the brochure link for people to download. That would be great. Second, keep an eye or read about the faculty pool. We have the largest faculty set in the peer group, and that is still not the good part of it, right? The good part of it is most of them come from the current industry practitioner backgrounds who are still dealing with the same market or life scenarios as a trader or a working professional as you would be, and they are training you with their life experiences. And the third path is the career and placement assistance. We did not touch upon that part yet, but we have a dedicated placement cell, right? A career assistance cell where people who come with an objective to get a job, switch domains. We do have 300 plus placement partners across 19 to 20 countries plus. And we have a dedicated team which caters to helping you get interview opportunities or job opportunities, build your resume, helping you have mock interviews and assignments so that it is more the probability of you getting cracking a job is much better. And we have lifelong support, and the key aspect of that lifelong support is whenever the program updates or evolves within the curriculum, you always have the access to the changed or the updated module. So whenever there is a new module added, as an alumni member, you'll always have the access to that as and when you request for it. So you can learn constantly without any monetary obligation. And the entire network of alumni. So we have around 4,500 odd people who have completed EPAT at the alumni pool. So once you complete, you can actually network all through this alumni to get a job, hire from the pool, have a business associate, expand it to different geographies, learn together, attend a book club. We also have a lot of alumni-only webinars, by the alumni to the alumni webinars, and so on and so forth. So that could be of good help. And then these are some additional resources that come your way, right? And so Blueshift, so Jay, when he was taking the session, he showed the tool Blueshift, which is our own backtesting tool. So people who want to practice what they learn, they don't need to go outside the environment. They can surely do, but if they don't, they want to be in the environment, we have a tool which connects with FXCM, Alpaca, etc., and even has Indian market data to backtest. The learning management system. So there is a dedicated tool which I will showcase for people who are doing EPAT, and the doubt solving sessions, lifelong support. And this is the LMS, the learning management system. So there are some live sessions which are there. So there are some of them. And just to let you all know, just to give you a quick sneak peek, even for people who are learning Python, say for example for the first time, say you are practicing something, okay? So say print your name kind of a thing. So whenever you go through a particular session and you want to go through a notebook, so your notebook will have a Jupyter notebook inbuilt into it, right? Say for example this. Now for some, it might look complex. Let's say that even I am starting from square one. And if there is an assignment I have to write here, and if I make a mistake over here, I can actually, I'm not getting this moving. Oh, sorry, my dashboard here is not moving, my panel. Okay, you can actually code over there and it can showcase the feature. The submit button is coming behind my Zoom panel, so that's the problem. Let me try again. So here I just add some gibberish, and okay, I got the submit button. So if I click it here, it will throw an error, most likely, yes. And then there is two ways. So either you work on this comment, the error, and if you're not able to, you get a hint and you go so forth, so on and so forth. Hint one, still not able to, hint two, etc. Now, though the idea is not to make it easy, but you should, when you're practicing by yourself, you should be able to cater to the questions that come to your mind, right? Similarly, you have a support manager who will come handy as and when you need, which is the human-to-human connect. These are the primers. These are the projects that will come your way. Every module has assignments and quizzes that would come to you. So you all can actually test yourselves. Your support managers will understand how to go about the things that are missing. So if you're not able to grasp, say, some concept of this module of EFS, you would be able to grasp that from the conversation that you will have with your support manager, right? Awesome. So that is the entire EPAT. So EPAT, like I generally mentioned, is not a program. Once you're in it, even as a participant or as an alumnus, we try to support across aspects for you, so that till the time you want to stop the association with us, we continue to support you on placements and career, on your own trade, your trading business, and on the learning front. Now let's jump into the questions. And before we jump into the questions, we have got, currently we are in the summer sale period of EPAT, like you see on the screen. This is live now, that is today. So if you all are exploring, there is a decent concession on the EPAT July batch, right, which will help you lock in your price earlier and easy on board. So anyone who is exploring, even if you're not exploring this batch, but you're exploring more about EPAT and how individually you can get help from this, you can possibly utilize the Calendly that Mohit will put now. Book a schedule. Either me or one of my team members would want to work on it one-on-one to answer your questions. And generally, you guys have a question about, my profile is this, how will I be able to do that, right? And my profile is this, would I be able to achieve Y if I do X? So that kind of questions, pricing flexibilities in the summer sale period, which is, I think, ending on 4th or 5th of July, but sooner the better. My team can help you get better onboarding over here. And the recording link will come to you tomorrow for the recorded version of this session. Awesome. The QR code is there. Please feel free to scan and land on the Calendly. If you don't, just there'll be another click which will help you redirect yourself to the Calendly if that happens. Now let's get down to the questions. Feel free to add people who want to drop off and do not want to get your questions answered from the questions of the panel. Feel free to, but I will take another 5 minutes to complete or go through the questions. Manashwi asks, what are the kinds of placement assistance? Manashwi, we, like I said, straight from getting job opportunities, interview opportunities, to career, your resume building, mock assignments, mock interviews. What kind of placement is across the entire horizon, straight from quant researcher, quant analyst, quant strategist kind of profiles, which is on the quant side of things, then on the development side, quant development and algo developer kind of profiles, risk management, credit risk analytics, and then front-end algo trader and quant trader kind of roles all through. Sarah Shaw asked, can you share the EPAT map? And that was more of a, that is not shareable, but if you all book a discussion together, maybe we can go through it again, Sarah. So feel free to let me know. The recording session, Dhruv, would come to you tomorrow. Aditi Patel, can we share Thomas's LinkedIn profile? We shall request or ask Thomas if that is okay, we would do. Snehashi's Day, what are the supports for employability? Sorry for the slip of tongue in the quant fields. We discussed that, Mr. Day. What would be the typical weekly time commitment required? Akshay Natu, depending on the profile that you have, I think somewhere around 45 minutes to 1 hour, if with a decent profile, should be good enough on a daily basis. So weekend lectures, 3 hours on Saturday, 3 hours on Sunday. But during the week, say around 45 minutes to 1 hour. Generally, it is recommended 5 to 6 hours, but when I had started EPAT, I generally would recommend slicing it into per day time. Sam Mir asked, if someone is coming from a non-finance background like engineering, is interested in entering finance world, is there a specific area of quant trading that allows more independence and flexibility, like working solo or remotely? Sam, good question. I think one of the good things that came after the pandemic was the borders opened up a lot, right? So we almost doubled our job opportunities or placement partners during and after the pandemic, considering that people are now okay with having someone in Southeast Asia working for a US-based company, right? So yes, and then there are a lot of project-based assignments, Sam, that can help you latch on to certain working opportunities. Awesome. Leander Ignatius, what are the concepts similar with EPAT and CFA? The concepts are similar. CFA is much broader, but very essential. I think Tomás put some light on it when he was talking. However, EPAT is very focused towards quant approaches in financial markets, right? So if you're dabbling around with modern ways of trading and analyzing your data and executing, EPAT is a good layer to have after before CFA. CFA, of course, as a different objective towards the end. Let's take up 2 more questions in 2 more minutes, right, if we can. Considering CQF is more formal degree, how is EPAT different from CQF? Snehashish, CQF is more quant approaches across the finance background. And the thing that where we are differentiating from the peer group organization is the practicality aspect and a very deep focus on financial markets solely, right? So we are dealing with quantitative approaches, common across. We are dealing with how to inject Python and programmatic tools, common. How to apply that to an industry application of financial markets, to an extent common, and how to achieve practicality with broker platforms, their market data, helping with support even after the program, career, retail trades, etc., where we're trying to add the maximum value as much as we can. And EPAT, I think from the year 2017-18, we have been with your examination became centralized and proctored by Prometric, which is of course a well-known organization is done in third-party monitoring and proctoring of exams. Now these are in-center exams, and that helped us to get a lot of accreditation across the globe, be it CARB, CPD, IBM, as I spoke about, but also helping us get a lot of organizations as participants and placement partners, because now it has become very closely, I mean, it has become very closely observed a program because of the accreditation. Derek asked, you said something on retail traders is separate from full 6 months. Now, Derek, one of the objectives and type of participants who join EPAT program are retail traders, which consists of around 24 to 28% of the entire audience, sometimes more, depending on the batch. Thanks, Martin, for your thank you. I am most welcome. Sushant mentioned the EPAT fee is on a higher side. Yes, Sushant, we do. Okay, the idea is to help the faculty set, the brokers, the trading platforms, the lifelong support, the kind of support. So when you get into the program, you will really realize that the kind of support that comes in is awesome. Like people have become friends with his support managers eventually, right? And it requires a lot of dedication from our team and yours to help you get that completion of the program, and not just completing, but actually you be able to apply this in. So we are not looking at you getting the certification and getting done with the association. Even after the program, we continue to assist you lifelong, even if it is as basic as your trades done by yourself, right? So the idea is to add value and you being able to apply, right? So that is the idea overall. And when actually you go to see, we are, if you see, we are increasing, we generally tend to increase the fee every year with, of course, certain additions to the program. We started the program back in, 2012, 2013, which was under $1,500, $2,000, right, back then, and which was 10 years, 12 years ago. And the next fee increase is coming in 2026 for select economies. So if you are really keen, I would want you to explore the flexibilities and the current fees if you can. I think 2026, the first batch, Jan might see certain increase in selected geographies. Awesome. Thank you, Sushant. That was a good question to end. Yeah, okay, let me take one more because I don't want it to be. Is there a significant disadvantage of a self-learner given proper background to one who takes up EPAT? No, depending on two things. You have the entire toolkit with yourself, right? And you are very disciplined and very timeline driven. You would be able to now do it by yourself. EPAT is, if you are really would love to have one-on-one support, faculty and mentor interactability, you getting hands-on projects, you always being checked upon, motivated, etc. during the program, and certification, which holds a lot of value for you to get into this industry, and assistance for career, which is lifelong and unconditional, if I may say so, then EPAT is better, right? So that's why generally when you benchmark against a self-paced platform vis-a-vis not say university, but a certification program, the completion ratio for a self-paced course would be a little lower or drastically lower as compared to when you have support, that environment, that kind of checking, etc. The check-ins done by a support manager. who is available 7 days a week, the chances of you grasping, applying everything becomes much easy. Awesome. I hope that answers your questions. I'll not pull further. We are 20 minutes delayed. Thank you, everyone. Lovely to have you all as an awesome audience. I never thought we would have these number of questions that are still pending. Mohit, let's put the Calendly for the one last time. Thank you again, Tomás and Mrinall and Jay for adding value to this session of 2 hours. And thank you, Mohit, for conducting this fruitfully. Please do reach out. There will be a survey after this, most likely. And let us know your feedback for us to do much better a job in the future sessions with you. Have a good one. Thank you.